So this is a very clear and a typical example of what your 9-box rule should look like. It was done by a fellow students of mine. All right, all of you are my students. What am I saying? A fellow trader of mine, which was just as you all are in the general channel where you learned what you learned today. Your fellow trader did this, and I decided to use this his own for the illustration to show you exactly what your trading plan should look like. All right. So
Okay.
So I'll mute everybody now so that we don't have noises to interrupt the training tonight, this hour. So if you have anything to say or ask, just use the chat box. All right, there's a chat box on your Zoom there. Let me just send hello traders. All right, so if you have any questions, you want to use the chat box. Okay. Now, people are still joining. Anyway, it's being recorded, so there's no need to wait for anybody. So as a trader, number one, it's always important for you to have a trading plan. I don't care if you know technical analysis. I don't care if you know price action, all right? Even if you know all of them, if you know how to follow market structure and you don't have a trading plan, you're not a complete trader. That's number one. You are not a complete trader without a trading plan. Now, what does a trading plan do for you? A trading plan helps you to stay put in the markets. A trading plan puts you together when you are trading. When you have a trading plan, it looks like you look like one who knows what he's doing in the markets, right? Even if you don't know price action and technical analysis, but you have a trading plan, you look like a trader who knows what he's doing in the markets. Very, very important. Every single trader should have a trading plan. Now, if you guys can remember the text that I gave you guys, I told you that a trader, your trading plan tells you when your trading plan tells you when to leave the market and when to stay in the markets. All right. When you have a trading plan, your trading plan is your, what do we call it? You can call it, your trading plan is your ruler. It rules you on what to do. It's your director. It directs you on what to do in the markets. So your trading plan is your foundation as a trader. All right. So once you have a trading plan, you know exactly when to enter the market, when to exit the market, what to do if you are in the market, whether you should place a stop loss or not. What that is, your trading plan gives you ideas of things to do and things not to do. So it is important that as a trader, you have a trading plan. Whenever you want to take a trade, be it with your on your PC or with your phone, always make sure you have your trading plan close to you. All right. So even as you have it as on your paper, right, you want to stick it somewhere to your, maybe wherever your PC is, or if you're in front of a big screen, you want to stick it somewhere close to you so that you can easily look at it and figure out what it's telling you to do, until gradually you memorize it all and have it at the back of your mind. So as a trader, number one rule in your trading, in your 9-box trading rule is the market. You want to first of all ask yourself, what markets am I trading today? All right. What market should I trade today? Should I trade the Forex currency market, or should I trade the volatility index market, or the boom and crash markets? That's the first thing you want to ask yourself. I always advise my students that if it's best for you to know which market you're good at and stick to it. Quite a lot of traders, what they do is they want to trade all the markets. If they're in the forex, if they're in the currency pair market, they want to trade all the pairs. They want to analyze GBP USD. They want to analyze Euro USD. They want to analyze JPY. No, as a trader, it is not must that you must trade every single thing you see in the markets, because that's one of the reasons why you see traders make money and end up losing it that same day. They've made money from VIX volatility index 100, and then they saw something looking good in step index, and they want to put their head into it again. Meanwhile, they must have made quite a lot of money from the trades they've taken so far out of VIX 100, only for them to step into the step index market because they saw something good and they end up blowing up all they made from VIX 100. That's what happens. So it is best for you to know what market do you want to focus on today. If I want to focus on step index and VIX 100, let me focus on it. Let me catch all the moves in the market, get all I want to get and leave the market. Very, very crucial as a trader. You have to be disciplined. Very, very important. You have to be disciplined. It takes discipline to be able to stand tall in the Forex industry. If you're not disciplined, you are making a big mistake. I don't care if you know how to analyze the market like a guru. Indiscipline shows that you're not a real trader. So your number one discipline is you sticking to your rules. So under the please, nobody should turn on his or her mic, I beg you. So under your number one rule in your 9-box rules is your markets. You want to figure out which market to trade today. All right. Some traders who love to trade quite a lot of markets can decide to say, okay, today I want to trade just the volatility index market, maybe volatility 100 or 75 or 25. All right. And then tomorrow you can say, okay, today I want to focus on boom and crash. That's fine. But personally, I recommend or advise that you learn to stick to one particular market. If it's volatility, stick to it. If it's boom and crash, stick to it. If it's currency pair, stick to it. All right. Don't always want to analyze both VIX, boom and crash, and currency pair, all of them together. You just get yourself confused. Sometimes you end up seeing yourself analyzing VIX 100, and because you're busy looking at boom and crash, you miss the move that you were expecting for you to take a certain trade in VIX 100. By the time you get to VIX 100, you just be like, oh shit, I missed this move. What were you doing? Why did you miss the move? You missed the move simply because you were looking at boom and crash, the market you analyzed an hour ago, expecting price to get to a certain level for you to take your trade. You forgot it and you were looking at boom and crash. And out of that anger of you missing your move, you'll be like, man, I need to enter this thing no matter what. And you just flip yourself into the market, and it ends up being that you have entered the market at the wrong time. And then you lose something you have made so far. So that is why it's good to know the market you want to work with for a day and stick to it. Number two is your time frame. Now, when you have figured out the market you want to work with, okay, the next thing you want to ask yourself is, what time frame am I going to make my analysis from? Now, as an intraday trader, an intraday trader simply means you're a trader who is trading what is happening for a day. You're not like those who want to trade a whole week. You don't want to, you're not like those who want to drop a trade to run the whole week or the whole month. You want to take your trades in a day and take your profit in the day and leave. So you're an intraday trader. So as an intraday trader, it is best advisable that you begin your analysis from daily time frame, or at most from your 4-hour time frame. So as a trader who has a trading plan, you want to ask yourself, what kind of a trader am I? When you figure out the kind of a trader that you are, then you want to know which time frame is best for me to make my analysis, and which time frame is good for me to make my take my entries. All right. So just like me, for instance, sometimes I analyze right. Sometimes no need hopping straight to daily time frame. You can start from your 4-hour time frame, okay? Or after all, if you're using your PC, you have the 8-hour, 6-hour time frames on your MT5, so you can be able to see some other hourly time frames that you can make your analysis from. So as a trader with a trading plan, you want to ask yourself, what kind of a trader am I, and what is my best analysis time frame for analysis and entries? And number three is your risk management. Now, after you have found out which markets you want to analyze, and you have finally made your analysis, you have set up everything, and you set up your entry level where you want to take your entry from if price gets to that level. The next thing you ask yourself is, when you look at your trading plan, your number three is your trading plan is telling you, hey, look at your risk management. Very important. So you see how the trading plan guides you gradually. All right. So sometimes you don't need to stress yourself thinking, oh, what should I do first? What should I do second? What should I do third? All right. Your trading plan is already there fixed to tell you, hey, number one is look for the right market to analyze. Now, something I just remembered. All right. Under the number one, okay, is not just about looking at the markets to analyze, it's also about looking at the good markets to analyze. All right, looking at the good market to analyze, because there are sometimes you see some bad markets. Quite a lot of traders don't know that they are bad markets. They just feel is once I open a chart, anything I see, I analyze. No, there are actually bad markets that you shouldn't even put your head into it. And they are actually good markets. All right. We'll talk about that when we get to the fourth, the number 4 trading plan. So back to number 3. Blow it the same day. It happens. And I'm sure a lot of you have experienced it too. Why is that? Because they don't have a trading plan. They don't have a risk management plan. Do not risk more than 3% of your account per trade. In any trade you take, if you're going to open one position, all right, make sure that if you're opening one position, you set your stop loss 3% of your account. So if you have $100 account, you want to ask yourself, that's the number one question you want to ask yourself, how much is 3% worth to my account? How much is 3% worth to my account? So when you figure it out, when you make the calculation and you ask yourself, how much is it? You find it out, and then that's what you want to stick to as a trader. I don't want to lose this amount per trade. All right. If it's $3 that is equivalent to 3% of your $100 accounts, right? Then you know that if you're opening one position, you don't want to lose more than $3 per trade. If you want to open two positions, it means in one particular position, you don't want to lose more than $2, and in the other position, you don't want to lose more than $1. If it's 3%, 3 positions you want to open per trade, you don't want to lose more than $1 per each entry, per each positions. And that's the last you should stick to. Even I don't advise you to open 3 positions. If you have a low account, always stick to at least one position, at most 2 positions. Why is one position more better? One position is much more better because if you're understanding everything I'm communicating, use the chat box. I cannot hear sound. Oh, there's no sound. Can you guys hear me? Some people say they can't hear sound. Hi Tim, thanks for the invite. If you can hear me, just use the chat box and let me know. If you can hear me, traders, use the chat box, let me know. Yes, we can hear you. All right. So if anybody is not hearing me, it simply means you need to check what's on your setting. Okay. So to number 4, we have in our number 4 rule, we have ranging or trending. You want to ask yourself, what kind of a trader am I? Am I a trader who loves to trade in the range, or am I a trader who loves to trade in the trend? Now, a ranging trader is that one who loves to scalp. All right. You want to scalp when market is an overbought or oversold. That's what you want to do. You want to buy, you want to sell, you want to buy, you want to sell the same markets in the same day. That is a ranging trader, and that's what we call a scalper. All right. Majority of we boom and crash traders are scalpers. All right. That's where you use your RSI to sell from overbought and buy from oversold. Those are scalpers. All right. But the thing is that oftentimes we don't even know that we are scalping. You understand? Sometimes you don't even know that you're scalping. When you are buying from oversold and selling from overbought, you are actually scalping. But the thing is, you don't even know if you're actually scalping a ranging market or a trending market. You're just okay. Uh, when the market is ranging, it goes like this: up, down, up, down. This is a ranging market. This is what we call a ranging market, right? So it's very interesting if a ranging trader or a scalper is taking trades from a market moving this way, because all your attention is, okay, if price is here, I know it's an oversold, so I should buy. And whenever it buys, you know, okay, that this is where the range is really struggling from. So you know that once the market is here, I should look for my selling opportunities to scalp it downward. The same thing upward, downward, and just like that. So that's why it gets interesting if you're a scalper to trade in a ranging market. Okay. So the next one is, you want to ask yourself, am I a trending trader? Am I a trend trader? As a trending trader. So that's why everybody have their different skills in their various fields. All right. A trending trader cannot challenge a scalper in a ranging market, and a scalper cannot challenge a trending trader in a trending market. Because what's the difference? I'll show you the difference. Now, here in my trading view, let's go straight up. If a if a ranging trader sees a market like this, let me just clean it up. If a trending trader sees a market like this, what do you think comes in his mind? Number one, he's seen that it's a bullish market. Number two, all he does is he buys. When the market begins a pullback, he either takes his profit or locks his profit, and he's looking So since that's his field, now what if he wants to challenge a trending trader, a ranging trader, I mean to say, all right? It's going to be very difficult for him to trade this kind of a market because he's not used to it. He's only used to catching end of pullbacks. He's not used to market moving up and coming all the way down, moving all the way up, all the way down. He's not used to it. And a ranging trader cannot challenge a trending trader because a ranging trader is only interested in market gets so high to somewhere and he wants to sell all the way from there so low to somewhere. All right. Because if he had two different kinds of traders, and that's what you want to ask yourself: what kind of a trader am I? So your trading plan helps you create your trading style. Number 5, your entries. Now, after that, you have figured out the market you want to work on for the day. You have figured out your time frame to make your analysis. You've done your analysis and everything. You've figured out how much you want to lose, and you figured out where you want to set your stop losses. You figured out what you want to do, whether you want to trade a ranging market or a trending market. All right. Then you get to number 5. Number 4 says, as a scalper, I will get my best opportunities in a ranging market, or as a trend trader, I will get my best opportunities at a trending market. Now, number 5 is your entries. What kind of entries do you want to take? Do you want to be taking entries okay, so you can do a pullback, you can do your pullback, you can do breakout, but you want to ask yourself, what should I really stick to? Okay, you can do the two, you can also stick to one. Like me myself, I do the two. I trade from breakouts and I also trade from pullbacks. Okay, if I will give a little illustration on that also, let me take it up here. This is the first illustration I made. Okay, as a trader who's trying to take his trades from pullback, call when you see price give you a move like this, maybe like this, like this. All right, ranging, and then suddenly, what did I just do? Okay, now your site, your view, what you're trying to figure out is where will this range come out from, up or down? All right, you want to figure out where is this range going to come out from. Is it going to come out from up, or is it going to come out from down? You want to know. So as a trader trading from a breakout, this is what you want to figure out. Once you see price give you that move, a breakout, okay, give you probably a retest and give you the good move. After checking out for all your confluences, you want to sell. Once all your confluences has aligned together, telling you good to go, good to sell, you want to sell. That is you trading from a breakout. Okay. Sometimes it could also break out to the upside. After all the move, sometimes get back in, comes out, now retest, is you only want to look for the opportunity where price breaks out to the upside. So unless your bias from the higher time frame is being bearish, then you can look for your opportunities to sell when you see a selling breakout. Don't forget that. Back to our plan. So number 5 is your entries. That is what you want to figure out. Then number 6 is your stop loss. Where do you want to stop? Place your stop losses. Number 1, you have by percentage amounts. That is, you have figured out how much is 1 or 3% worth to your account. So if you want to set your stop loss, you're setting it in accordance to the percentage you're willing to lose. That is it, number 1. Or away from market structure. Where do you want to set your stop loss? Now let's go straight for another illustration. If you're a trader who wants to set your stop loss according to percentage, you already know that if price is going against you gradually till it hits $3, if $3 is what you want to lose according to percentage of your account balance, it means that once price hits $3, your stop loss should be triggered. All right. But if you're a trader who wants to trade or who wants to set your stop loss according to price structure. Now, when we talk about price structure, markets going bearish gradually gives you the move, the first swing high, gives you a swing low, all right, and begins to respect structure, giving you the little pullback, swing high, swing low, swing high, swing low, all right. That's you seeing your lower high, your lower high, your lower high, right? And then you have the lower lows going downward. That's market respecting structure. Now, when we see market has disrespected structure, we're trying to say that a trending market that was going bearish in a very good up and down swing has suddenly disrespected the up and down swing. Now you can see clearly how this market was giving you the lower highs, all right? And suddenly what happened here? Price gave you another lower high here, but the lower low was not, it didn't go so low to as far to respect the market structure. But what happened? It stopped here. Not like it's not enough. Instead of going down, you even went upward, disrespecting the structure. All right, structure. So imagine if you are a trader who took your entry from, let's say you took your entry, maybe you saw the move here, and then you took your entry at the end of this pullback here. All right, this was where you saw you took your entry from here, and price was going your way gradually, and then this pullback began. Now, as you take your entry from there, if you're a trader who wants to set stop losses according to structure, it means that you want to set your stop loss. Since you took your entry from here, you want to set your stop loss somewhere around here. You want to set your stop loss somewhere around here above market structure. That means if price disrespects this swing low and goes against it, then I will have to stop I'll have to stop price here immediately. Once this structure is broken, let my stop loss be triggered, even though percentage stop loss. You want to work with price structure stop loss, because you just want to make sure that once this structure is disrespected, let my stop loss be triggered immediately. I hope you're understanding. So that is you being a trader who wants to set his stop loss according to price structure. So you see the difference between a trader who's setting stop loss according to price structure and a trader setting stop losses according to percentage. So if you are a trader who's setting your stop loss according to percentage, it could have been that since your entry was here, all right, this place is still your entry zone. So what your percentage hasn't started counting. This is your break even. So it means that maybe this move could be 1%, all right? This move could be 2%, and maybe here could have been 3% of your account. So this, if you're a percentage stop loss trader, it means your stop loss should be as high as here. All right. Now you see the difference between setting your stop losses according to percentage or according to price structure. I hope you're understanding. If you're understanding, use the chat box. Sorry, the audio is fluctuating. Ever experienced you take a trade in a day, you make profit only for you to end up losing it that same day? A lot of you said yes. That's the reason why I decided to bring up this training for you guys. Number 7, very important. You have to know what kind of trades you want to trade. Okay, fixed targets or trailing stops targets. Fixed target or trailing stop. Now, when we talk about fixed target, this is you telling yourself, if I can make if I can make a certain percentage, or sorry, this is you asking yourself, okay, let's go to the chart. It's going to be more easier that way to explain. Now, you take an entry, all right? You take an entry, let's say you're selling, all right? And then you sold from here. Let's say you took your selling opportunity from here. This is where you sold from. And then you want to ask yourself, where am I to take my profits? Okay, where am I to take my profit? As someone who has analyzed the market, you've seen all the places that price must have created supports and resistance in the past, right? So you know area, you should know areas where you should take profits. For if, for instance, where is my replay? I'd love to use this replay. I want to give you guys a typical example so that you see and learn it well. Now, I'll play from here. Good. So for instance, you got into the chart, you've done your analysis, this is where you saw price, and then you took your sell from here. You took your sell from here. All right. As you've taken yourself from here, you should already know where price might likely end to for you to take your profit. Now you might want to be a trader who wants to set your take profit here, because this is where you can find a previous resistance in the past that could become support. So you've taken your entry from here, and price is gradually going your way, going your way, going your way, and what happens? Boom. Now price has hit your take profit, and you take your profits. That's number one kind of a trader. All right, that's number one kind of a trader. You take your entry and you set your take profit. That's number one kind of a trader. Another type of a trader is one who, once price is getting close to his take profit, he wants to do what? Trail the take profit down deeper. All right. And then price is still doing his thing, going deeper. and your entry is still in place, you're in massive profit, and the price is going deeper and deeper and deeper. But now what is happening? Price is beginning to go back upward. All right, price is beginning to go back upward, but you're still watching and observing. You're trailing your take profit, but you must understand that while you are trailing in the markets, you're still in the markets. What you're doing is you're trailing your stop loss and your take profit. All right. Why some traders who want to set their take profit strictly should have taken their profit from here already for a long time ago, and probably looking for another entry, or that's enough for them for the day. All right. So that's you being a trader who sets your take profit by fixed targets or by trailing your stops. Okay. Now, number 8 is your daily stop. Your daily stop means how much are you willing to lose for the day? We have just 1 minute and this session is going to end. Once it ends, okay, everybody use the same link to join again so that we will complete the training. So your daily stop is, if I lose 5% to 10% of my account, I don't want to take a trade again. I'm out of the market. That is what my trade